Hey all, welcome to ShareTreck. This is Raj here. Friends, I have come back with another video today because I have some thoughts around the economy and the inflation and what it's going to do to our genomic stocks. So this is a brief segment that I am recording. And I hope to get your feedback on what you think about this because mutual discussion always helps to get a better idea of what's happening in the market. So let's get started. Well, friends, I want to take you to this chart, which is in CNBC. And I'm looking at the inflation breakdown for December 2022 in one chart. And if you look at fuel oil, it is 41.5%. This is actually the breakdown, the biggest components if you look at it. So we have fuel out here. This caught my attention. You have utilities, which caught my attention again. They are all linked to each other. That is at 19.3. And then if you were to look at electricity is 14.3. And then let us look at rent of primary residence, which is out here, which is at 8.3. We do not have mortgage payment, but people who are not paying rent are paying mortgages. And so that's another aspect that I want to talk about. So these are some of the main components of inflation. And we all know that oil price has been quite high for a while. And then if you were to go and have a look at oil prices, let me show you the chart here, US oil. So if you look at US oil here, US oil peaked out in June, as you can see out here. And since then, oil has been falling. And off late, it has started picking up a little bit, but it has fallen significantly from around 10th of June. Next, I'm showing you this chart here, which is showing the trajectory of inflation. And it shows that inflation had peaked somewhere around June. And then since then, it has been dropping. So if you go to have a look at US oil, you will see that US oil peaked somewhere around 10th of June. So if you compare the chart out here, the June chart, the chart for oil, it peaked on June and it came down. And if we were to look at the inflation also peaked on June and then it has come down. And there's a strong correlation between the oil price and the inflation, right? And I'm thinking that this again adds to the argument that raising the interest rate is probably not the right solution for this situation. The inflation has been caused, in my opinion, by twin factors. First is the increase in money supply due to quantitative easing. And the second is the high price of oil. I have already shown you the evidence of high price of oil and its direct correlation with the inflation. So if oil price fell worldwide and the US inflation went down, it's not because of the raising of the interest rates. The oil price has gone down and that has percolated into all parts of the economy, just like when the oil price went up and everything went up. So we need to address the oil price issue, and that's being driven by the Russia-Ukraine war. And therefore, we don't have a handle on the oil price. It is happening due to forces out of our control. And the other thing I'm saying that is the quantitative easing. So when quantitative easing was done, a lot of money was introduced into the economy. Therefore, quantitative tightening to withdraw money in circulation would be the best approach instead of raising interest rate. Whatever we do, it's definitely going to hurt the common man who is the major support for the economy, because 136 million people across the country are paying money into the economy to buy stuff. And if quantitative tightening is done by withdrawing money from the market, it could be done by two things: by not renewing the bonds that are coming up for renewal, and by doing that, the Fed will be taking out the money from the market. And the second thing it could do is not renew the mortgage-backed securities. And by doing that, it will curb the ability of the banks to give more mortgages. And these two things will gently pull out the money from the market. And further interest rate hikes need not happen. That is my personal opinion. And that's why, and that's the way I think a proper soft landing can come. And I'm thinking that if we do not do that, but instead if we were to raise the interest rates, we are likely to get into a recession, because when quantitative tightening happens, it will be felt at the leading edge by corporates and big establishments. If it was done by not renewing mortgage-backed securities and by not renewing bonds that the Fed purchased from the corporations. Whereas when interest rates are raised, it will hit millions of people who have to pay mortgage, credit card dues, car loans, or business loans and overdrafts. When low interest mortgages or business loans come up for renewal, many may not qualify and will have to let go of their homes and businesses. This can be happening right now, and we may only find it out after the fact, because we have backward-looking data which will then show us that a couple of months ago certain things happened. We just have anecdotal evidence. As we saw in the CPI chart, fuel and rents are two big categories. What we don't see there is the mortgage payment of those that do not rent. When people are forced to renew at a higher interest rate, first of all, if they can't qualify for it, they lose their homes and they will have to go in for rentals, and the rental stock is not going up. Therefore, rents will start going up while the repossessed homes are in the process of foreclosure and then come back into the market and get sold at a discount. The real estate market is not in a good condition. Assuming that people are able to renew at a higher rate, then what's going to happen is that they are not going to have much of money left to buy other things. So therefore, they're going to cut down on their consumption. And all these things are not going to happen gradually, but they're going to happen in big increments. So it will hit us all of a sudden. And that's the reason why I'm not a big fan of raising interest rates. So I'm very anxious on that account. I'm looking at how it goes. I'm watching the CPI chart very carefully. The CPI chart breakdown, which I showed you before, it has clearly shown fuel at 41.5% and rent of principal residents at 8.3%. Whatever can be done to target those two components of the CPI may have a quick impact on the inflation. Also, excess money supply has to be mopped up by not renewing MBS and bonds coming up for renewal. So that's kind of my conclusion. Another factor to bear in mind is that as the Fed raises interest rate, the country's interest burden increases, and the money that could have gone for infrastructure or something that is more productive for the economy is going to be spent on increased interest payments. Already we are approaching the debt ceiling reauthorization, which involves a lot of brinksmanship, a great deal of volatility. If interest servicing is going to be a big component of the debt, then the conservatives would argue for abolishing Social Security and Medicare instead of increasing tax on the top earners. And if that measure was to pass, then I'm pretty sure that this will push us right away into recession, as many people who depend on Social Security and Medicare would not be able to spend on their basic essentials, which is the table stakes for the economy. When that demand goes away suddenly, it can push us into a very sharp recession. For us as investors, it means that we are going through a very volatile time domestically and internationally. We have the Russia-Ukraine war also. A lot of countries are in the brink of bankruptcy. Europe is doing better than expected. That's a bright spot in my opinion, but will surely feel some impact of not buying Russian gas. The Chinese economy is trying to recover while the Indian economy shows promises of taking over the slack from China as Apple shifts 25% of its worldwide iPhone production to India, and India continues to complete massive infrastructure projects for a few years in a row, leading to great connectivity, more green energy, and more power generation. However, what happens in China is what is going to impact us most, because US is more linked to China than to India. And along with what happens to Europe on account of the Russian conflict, those are the things that are likely to impact US. So we have our own internal domestic issues as well as international issues that we have to keep track of. So it's a very volatile period ahead, in my opinion, and we need to take it one day at a time. Relief seems to be in the fourth quarter of the year, this year. When it comes to our genomic watch list, suffice to say, things are not looking great at this point of time unless any of the companies get a FDA approval. I would count on Crispr Therapeutics as one of the most promising candidates in our watch list. Because they could have potential approval for the sickle cell disease therapy and TDT therapy. However, gains due to this positive event for CRISPR may not be as much as it would have been if the economy was in a much better time. I think if there was better economic sentiment, the gains would have been even more than what we could see under these constrained times. So those are my thoughts, and I thought let me put this across to the ShareTreck Nation and get your feedback. So please let me know what are your opinions so that I can get some new ideas from you and run it past my own model that I have in my mind, and fine-tune my perception of the economy, the market, and the trajectory that it's taking. Bye for now.